I was looking at one of your funds, and you are a veteran in the space of healthcare investing in India, which is such a nascent industry in India.
Yeah.
It is very mature in the United States, but in India it's very small.
Yes.
So can you tell me a little bit about why are you so bullish on the healthcare sector in India? Obviously, your returns speak for itself, 50%, 55% CAGR. And I think this year alone, you've gotten almost 18-19% returns
That's right. Yes.
when the market has been flat.
That's right.
So can you tell the audience over here, why is healthcare going to boom as a sector in India going forward? Maybe if you can share some macroeconomic trends or parameters.
I will do that. So look, India today is about $2,400-$2,500 per capita GDP.
Right.
Of which we spend about 3.5% on healthcare.
Okay.
Right. So look at your own households. Look at my household. Look at your own households. In the past decade, has your food and beverage spent kept pace with your earning growth? The answer will probably be no.
Has my food and
beverage spent
increased
in line with your earnings? So if your earnings have compounded by, let's say, 12% over the past decade, has your food and beverage spend
increased by
12% every year?
I would say no.
Exactly.
Yeah.
Same goes for your clothing. Has it happened? Probably not.
No.
But has your healthcare expense grown faster or slower than 12%?
I think it depends on what stage of life you're in, right?
That's number one. Number two, your family members. If you have elders in your family.
Okay, looking at a family as a whole.
Obviously, as a family. So you're looking at household income and you're looking at household spend on healthcare. So you're looking at parents, you're looking at kids, right? So young people like me and you in our 30s, 40s, we don't need to spend as much.
Yeah.
But people who are younger and people who are older definitely need to spend more.
Correct.
Right? So the whole objective of saying this is that for the past decade, once you cross $2,500 per capita GDP, roti, kapda and makan is largely taken care of. That is the global trend.
Yeah.
That after that, whatever incremental earnings come, individuals want to spend that earnings on themselves. I want to look better. I want to, appear better. I want to live longer. I want to live healthier.
Right.
And hence, healthcare becomes a very large part of your consumption bucket. Right. That is the trend.
Got it.
Now, this is the macro data. Now, let me give you how to make money off this macro data.
Okay.
So I told you over the last decade, India's GDP spend on healthcare has gone up from 2.7% to 3.4% per capita.
Right.
In the last decade, had you invested 100 rupees in Nifty 50, so 2012, 2012, had you invested 100 rupees in Nifty 50, today you would have about 420, 430 rupees. That's about a 12% CAGR return, which is phenomenal. Given that our inflation has been around 6 and 7, you have gained purchasing power by 5 to 6% every year.
So around in 12 years, it has become 4.5 times.
4.5 times, right? So that's a phenomenal return. But had you invested that same 100 rupees in India-focused healthcare companies, it would have become 1,300 rupees.
Wow, 13 times.
13 times.
So it would have been 3 times faster.
3 times faster. So while Nifty is giving you 430, healthcare is giving you 1,300.
Also, I think in Nifty, the allocation of healthcare is very small.
Very small, 3%.
Yeah,
it's just 3%. So you get negligible exposure. Even that 3%, Nifty gives you allocation on 3% on stocks like, let's say, Sun Pharma, Dr. Reddy, Cipla.
Which are not growing as
fast. These are exporters. They are not focused on the Indian healthcare ecosystem.
Okay.
So for these three companies, let's say Sun, Dr. Reddy and Cipla, which are the Nifty stocks, 60 to 70% of the revenue comes from Europe and US. Now, these are mature healthcare markets. They are growing at 1-2%.
Right.
So therefore, these stocks will not give you the kind of returns that the Indian healthcare stocks can give you because they are focused on a market which is growing at 10-12%. Right. So that's one angle that you already would have made more money. Now, is the valuation today basically accounting for what has happened in the past decade? So if I don't tell you what is happening right now, what you should presume is that, look, this bucket has outperformed Nifty by 3x.
Yeah.
Nifty is 430, this guy is 1300 over the past decade. Hence, public would have learned. And now these stocks must be really expensive, right? Because the public now knows that these companies will grow faster.
Right.
And food and beverage and clothing and etc. will grow slower.
Huh.
The answer is no. They just haven't learned. Let me give you data. Avenue Supermarts, our largest food and beverage retailer, right? The market cap is 2.5 lakh crores.
Okay.
The cash earnings are 2,500 crores.
Okay.
It's 100 times cash earnings.
Okay.
Trent, our largest clothing retailer, market cap 1.5 lakh crores, cash flow is 1,500 crores.
Okay.
100 times earnings, cash earnings. Our largest healthcare provider, Apollo Hospitals, market cap 1 lakh crore, cash flow 2,100 crores, less than 50 times. So what we do through our healthcare fund, Sharan, we are playing this simple valuation and growth arbitrage. a pocket which is growing faster, has been doing so for the past decade, will do so for the next 4 to 5 decades, is available at half the valuation of pockets which are going to grow slower and are very, very expensive.
Why has the market not realized this? Because the market is not just me and you. There are crores of people.
So look,
because this data is publicly available.
It's public data. Public. So numbers I gave you are FY25 numbers. So they are all actual reported numbers. These are not estimates.
Right.
And market cap is obviously real time. I don't know what people, I think there's a problem in the way the healthcare index has been designed. So the way, when I say healthcare, the first name in your mind before you heard this would have been Sun Pharma or Cipla or Dr. Reddy.
Yeah.
Now, if you look at their returns over the past decade, so Sun Pharma 10 years back was about $1,200 a share. Today, I think it's about $1,800 a share.
Not moved a lot. In the 10 years, it has moved by 30%.
30%. So that's about 2% CAGR returns or 1.5% CAGR returns. Same for Dr. Reddy's would be a single digit CAGR return stock. Cipla would be a single digit CAGR return stock. So when I say healthcare, people imagine these companies.
So basically the poster boy companies of healthcare sector has not performed well.
They have not performed.
And that sort of gives a negative sentiment to the entire industry.
Exactly. But if you are willing to go beyond the poster boys, stocks have done phenomenal
returns.
Torrent Pharma, for instance, large cap, 1 lakh crore market cap today. 10 years back, stock price was, I think, 500, 550. Today it is 3,600, 3,700. In the same time, that's Sun Pharma.
Can you repeat that?
So Torrent Pharma 10 years back was 550, 560.
Okay.
Today it is 36, 3,700.
Wow.
So it's been 7, 8x in 10 years.
Wow.
And this is Torrent Pharma and Sun Pharma. Now, to your mind, Torrent and Sun Pharma both are pharma stocks. Right? And Sun Pharma is 4 times the market cap of Torrent even today.
Right.
So for you, Sun Pharma is the benchmark of what is happening in healthcare.
Right.
But that's not the answer. Sun Pharma's 60-70% revenue comes from exports, which is Western Europe and US, which are 1-2% growth markets. Torrent Pharma's 90% revenue comes from branded generics like India. And this is a high growth market. And this is a market where you have branding.
Glad you made it till here. If this gave you even one idea to improve your finances, send it to a friend. Helping them might just make you the smartest person in their group chat. And don't miss the full episode on Finance with Sharan. There's a lot more where this came from.